Good morning, ladies and gentlemen. This is Clueless 8 Trading. Frank pre-market AM report. Keep it short and straight to the point for April 18th, 2016. We have had a lot of drama over the weekend. I'm sure all of you have peeked into the Twitter real-time post, which keeps you updated on real-time world events, which are material to financial markets. And the biggest news is that the oil deal wasn't reached, something that I had forecasted as a strong possibility on the time that the rumors had surfaced that Russia and Saudi Arabia had arranged on a had decided on an output cut or oil freeze. Whichever the case, we are having a minimal market reaction to that news because I believe that smart money kind of knew that this wasn't going to happen. We are not seeing a full-scale Armageddon fallout. Futures were down more than 12 points after market Sunday evening when we were doing our advanced coaching sessions, and now have halved that loss to down about 6 or 7. Saying all that, a couple of things we have to remember. We are in a strong part of a seasonal market. Okay? We have earnings, which are going to dominate, and don't expect earnings to completely fall apart as lowered expectations in the form of Wall Street consensus, which I believe analyst consensus is somewhere in the negative 7 to 8% range. So just like anything else in life, if you lower your expectations and you get a slight beat and something a little bit better than the worst situation happens, well, what do you think happens? Stocks go up. Now, it's never that easy. There are machines who dominate the market, and they make sure that whichever way you're leading a little bit too hard with the consensus, that they'll come in to demolish you. At this point, the macro picture shows that the leaning or the bias over in the overall markets by institutional hedge funds primarily, and Chicago traders and such, is leaning to the bearish side. That $1 trillion bet that they keep on talking about on the S&P 500 is far from removed. Therein lies the fact that a strong market will absorb any type of tactical retracement and move higher. I believe that's what we are seeing, given the fact that if this oil news had come out, let's say 2 months ago, we would be down a good solid 20 handles on the S&P 500 and opening down 200 points lower. But that is not the case. You can see here in the background, you have the E-mini S&P 500 futures, which you all should be tracking. I've been talking about this for years now on your own, down roughly about 8 points. So let's talk about some technical retracements which might happen this early part of this week, and maybe around this, maybe we will have a down week. It doesn't mean we're going to start off Monday morning and then continuously go down. Let's keep those childish type of thoughts out of the way. And given the fact that most of you listening to this at this point have experienced the nuances and the cunning behavior of the markets, you know very well that markets are not linear and they don't fall in one straight go or rise in one straight go. There's a lot of zigzags along the way, and that's exactly, excuse my French, screws up traders and investors. And it's tough. I realize that, but no one said trading's easy business, right? Anyone who told you that, well, I don't know what to say. So saying all that, let's take a look at some retracement levels here on the S&P 500, which I think are worth noting. So here we have pattern symmetry, which I've talked about a zillion times since the highs of last May, 2134 on the E-minis. Okay, the big flash crash, complete Armageddon scenario, right? Intense volatility, a retest of a higher low actually of back in September, and then a powerful upsurging rally that culminated in November. Then volatility, and then the big drop in January of 2016, culminating in a sharp move up, a retest, and all this has been documented, explained, analyzed, and acted upon at the Clueless 8 Trading Club to a large degree, because we don't fear fear, we try to profit from fear. So That's just the way it goes, right? Behavioral game theory. So then you have a double bottom and then this big upsurging move, very similar to this. In fact, have extended over this because we were coming off lower levels, and this is where the congestion point is, right? This is where we are. So that's the bigger picture. Let's now get into the precision game theory type of analysis that we do here. So first and foremost, let's look at some simple things here. We're at a congestion zone because this line here is a major sell zone, right? Supply point right there. And that is around 2100. So we have a little bit of room here, which I've talked about extensively. We do have a little bit of room here. All right. And that room is good for about 200 plus points. We could get that by the month of April, which is dwindling down to 2 more weeks, less than 2 more weeks if you count the number of actual trading days coming up in April. So we could get that. All right. In the meantime, this congestion point here, or supply point, whatever you want to call it, is exactly where we are, right there. And this is where we're heading some resistance. Now, how do we trade this? The way you trade it is not going to be simple because individual stocks will do what they'll do, and then you'll have the market do what they'll do. The oil supply, the deal falling apart is not a positive, but neither is it a great negative. I've shown oil where it can come down to, and that's exactly where it's bouncing off from. I said around 38, 39. Well, guess what? It's bouncing off 39 right now, as I see on my other screen, and I'll show it to you all in a few seconds. And you guys can see it on your own screens. On the daily basis, on the E-minis or the S&P 500, which is the overall market, not overall market, but what we track here, what traders track, we are starting to see we're seeing a topping pattern here, similar to what we're seeing here. And you could expect a large decline of this magnitude where we can fall all the way down to test 2030 and possibly 2000. And it still doesn't fully break the uptrend because these lines are still moving higher, as explained in my previous video cast. Okay? So you got to keep that in mind. All right. Now this reset here, if it resets all the way down here, and this being the daily, would be a terrific buying opportunity, in my opinion. Similar to what we saw here, similar to what we saw here, similar to what we saw here in the middle of these big volatility ranges, right? Gets this deep and sharp, you're going to have a tactical bounce. But we're not there. Where we are is midway. We're in purgatory right now. We're hanging there. And the bottom line is we don't know whether this line is going to come down here and reset rather quickly, which would be a 300 to 400 point type of drop in the market, or are we going to just turn from here? The longer the market stays above the RSI, that means the longer the market is overbought, but it also signifies there's a lot of strength in the overall breadth of the market. And that's something to keep in mind, right? What we want, the market doesn't always do. We want resets, right? We want resets. And the bottom line is that allows us a chance to get into things a little bit cheaper and all kinds of good stuff. But the market's not going to give that at one time. So you got to be flexible. You can trade during the day, close out the positions, or you can basically keep positions tight and try to get out as quickly as possible if it's going the other way. I'll be the first one to admit the S&P short side of the picture last week completely blew up. It was a loss. Didn't feel good, but hey, that's the market. What are you going to do? There were other huge winners on the long side, which worked out fantastic. So saying all that, we have this reset to complete. Now, whether or not it's going to do this and move, come down here to about 60, just you can train your eyes to look at this and bounce from here. So that'll be a nice consolidation channel, or whether it's going to come down all the way down here, test 2030, which is roughly about 200 points from where we are, or whether it's going to test the lower end of the Bollinger at around 2000 on the S&P E-minis. We don't know yet. Earnings will dictate, but overall, some of the strongest sectors in the market have shown some real strong earnings, i.e. banks. So we have to be careful. This is a strong uptrending market with tactical retracements. So now let's take a look at the near-term picture. So this is, I put some absolutely fantastic charts out there with arrows and stuff. I can't get any easier, better than that, and easier than that for all of you to see. So what we see here is a head and shoulders pattern. I showed this on the charts, and I think that's what's going to play out over the short term. And the short term can mean a couple of hours, for God's sakes, in this type of market. So we have a head here at around 2080. We got a left shoulder at around 2075. A right shoulder if it gets up there. This is a right shoulder. This was the neckline. We are right at the neckline and going down. A test of 2057 would be sufficient for now or today to have a quick tradable bounce. Tradable bounce means we would basically bounce from here up to the 2070 level, which is the downward sloping 34 and the 50-day moving averages, these two lines. You got to just know, you just have to get these verbiage and these indicators as second nature, okay? And you'll see how everything falls in place. Timing is tricky, but at least you'll see the bigger picture. We have a STO which got overbought overnight. It was oversold. We were down here, right? We got oversold on the 1 hour chart. Guess what we did? As I'm doing this video cast, we're overbought. And now we're on our way to get oversold. It's not going to be like immediately, but it might take half a day for all I know. But at least you know what you're looking at. Everyone says they want to learn, right? My famous last words. Who wants to put in the blood, sweat, and tears and a little bit of effort to understand the dynamics of learning? Every high school kid says, I want to learn. And then they get D's because they don't put in the hard work. And the tougher the course, let's say Calculus AB, Pre-Calc AB, all right? The tougher you got to work for it. It's the same thing on this side of the business. So please, got to put in your work instead of just saying, I want to learn. That's easy to say. The hard part is doing the job of learning. So, and I'm still learning. I'm learning every single hour, I should say, in the markets and the nature of the markets and processing information at the same time to help and benefit my members. So, appreciate that. And I don't need your compliments. I need your work on your side to make it simpler on me. How about that? I hope you guys all got that. So saying all that, gets oversold, it's a buying opportunity again. Trend from what it looks like, I think we will test that 2050 level here. And if there's a full-scale retracement over the next 48 hours till Wednesday or so, let's say by Wednesday, then we're looking at the 2030 level. The key number is the 2020 on the S&P 500. We'll look at the chart in a second. And below 2020, all hell breaks loose, all right? Because that's a number the market has held. But this pattern, as we're looking at right now, is telling me that I'm going to hold on to those S&P puts, the SPY puts and such that moderate amounts that I bought over on Friday and suggested to everyone that we will at least come and test the 2054. So that's roughly about 13 points from here. Now, will that happen on my time? Absolutely not. It might not even happen because this is a strong upward trending market. It could be that this was the lows overnight. Now we're creating a consolidation channel, and it's possible that the market can then do this. And that would be another pattern which wouldn't be out of the ordinary. Right there, it would all of a sudden become an inverted head and shoulder with the head, with the left shoulder, with the right shoulder formed here, with a neckline, and then a breakout back towards 2085 or so. Believe me, this could happen too. There is absolutely no guarantee whatsoever, but then there are no guarantees in life for trading either, that this is going to come back and retest this, in which case it would be a W formation or dragon bullish. So all these are out there. In the meantime, the internals are suggesting that we will have some type of retracement. But at the same time, it's very possible, futures which are down about 8 points, a little bit more than 8 points right now, it is very possible that it caps it and the STOs move from here. So it's up to you to track it and up to me to update it and show it, and you act as needed. Let's take a look at the S&P on the same chart. Here's a daily chart of the S&P. You can see that. As you can clearly see here, there's no material technical damage whatsoever. This is a daily chart. there is no indication that this crossover we're seeing here is going to do this. In other words, a good solid couple of 100 points retracement. It could very well just jostle around here and stay above 80. In this case, yeah, above 80. It could very well do that. If you look at this and squint your eyes, it doesn't show any major deterioration. We are still within this Darvas box, which looks like it's a bottleneck wanting to go higher. So net on the daily side, the market still has strength to move higher. There's a couple of things going on here that you have to be attentive to. Number one, for example, this is a consolidation channel that broke out very nicely. It's very possible that a quick retracement will bring us down towards closer and narrow the gap between the rising 34-day moving average and the rising 50-day moving average. Because the further you move away from it, and it's not extreme for a distance here either, the standard deviation gets wide and you get a quick correction. But this is not telling me, to be honest with you, that we are about to completely croak. Now, I have four minutes left to cover this stuff here. So what would break the trend would be something like this: a brick solid breakdown at 2030, a failed bounce up a little bit this way, and then a failure at the 50-day, which should come back and test this 1975 level, which is the upper end of this downtrend channel, and that would really scare the living daylights out of the market. Okay, and if we fall into this channel, you will see a phenomenal number of stops triggered and a very sharp move in the market, and will come down to 1875. So I'm talking about moderately extreme situations which might develop. In my opinion, those develop in the month of May. And it is also possible that in the month of May, projecting forward, we can test this 1800 level, which if holds will then again ensue in another very powerful rally higher. And now that we have had experience multiple times in these very large 1,000+ point type of dragon bullish formations, we'll be more ready and more open to putting out some sizable positions and leaving it in there. So at this point in time, that's your daily chart. If I see this slows break below 80 and rapidly fall, that's a different story. Let's take a look at the hourly on the S&P 500. Now, why is all this important, especially for newer members who are listening to it? It's important because it doesn't matter what stocks you're trading. Most of the times, you will get hit if you don't understand what's happening on the background. All right? That's just the way it is. You can deny that you don't need to know about the market in order to trade. Well, that's garbage, in my opinion. You need to know the background and the ground that you're standing on before you're starting to walk over it. So looking at this here on the 1 hour side on the S&P, this was Friday's close. Looked pretty good, right? So right now, this is not real time, obviously, because these are not trading right now. The S&P, the E-minis are. We could, we will see how it opens up. We'll see how it opens up in about at 9:30, and we'll go from there. You have levels of resistance at 2072, support at 2072, 2065, and then the uptrend line, which I showed before. Well, this is the channel. The uptrend line is, I would say, around 2035. Okay, 2035. Do we fall that rapidly, that sharp? I don't think so. But who do I know? Or what do I know, right? Earnings season upon us right now. Let me show you oil while I'm wrapping up this video cast. Earnings season is upon us, and we have Netflix tonight, which we're certainly going to play. Oil right now, this is important. Let me explain this very quickly. I showed this here. The two ways to read it. The bullish guys, oil traders, are going to say this is simply a consolidation channel. That this is simply a consolidation channel, and that we're going to break higher. I would say retrace down to with a $36, $38 level, $37 level would be healthy. We are seeing a breakdown here in the stochastics, but nothing major. Oil, in my opinion, will hold the 34-day moving average and then bounce from here. So again, if somebody was really uber dogmatically bearish, this is not a market they're feeling too good about because it's not collapsing. Thank you for listening, and welcome to Clueless 8 Trading.